Today's lesson will be on participating whole life insurance. A whole life insurance, in actual fact, is a division of what we call permanent insurance. The reason why we say it's permanent, because you really can't outlive this. In other words, you will expire before the actual policy expires. This is coverage really for the rest of your life. That's why we refer to it as whole life insurance, and we refer to it as permanent insurance, because basically you're going to be covered for the rest of your life, unlike term insurance, which has a limited amount of time that in actual fact you have for the coverage. Now, it is participating, and that's very important, because participating, what it basically means is what you've got is dividends. So in other words, it is a permanent policy, but over and above the cash value of the policy itself, you also have an opportunity to participate in the company's growth, basically. So you're basically paying a higher premium, but that extra premium will be invested on behalf of you, obviously, by the company and everything, and they will then, in turn, give you what we call dividends. Now, what's very important to remember about the dividends is that dividends are not guaranteed. So therefore, even though we say that the company will declare a dividend, it is not mandatory. It is like any other dividend, purely an optional situation. So if the company runs into difficulty or decides to use the money for other purposes rather than distribute the dividends, then you will in fact not get any kind of dividend whatsoever. Now, because they're not guaranteed, that means that as you're making your plans to go forward, you're going to have some options. You have these options that you can actually use these dividends for different purposes. And so what we call the 5 dividend, or what we call 5 options or 5 dividend options. As I indicated, the dividends are not actually guaranteed or anything, but there are 5 individual dividend options. These particular options are to be chosen at the beginning, in other words, when you in fact apply for the policy. What are those options? Well, the first one is the most obvious one. Is they simply every year, as they declare dividends to you, they will simply send you a check. Now, please note that these are always done on the anniversary date of your policy. In other words, if your anniversary date is October the 1st, therefore, on October the 1st, you will get, in fact, a check will be sent out to you. Once again, not guaranteed, but it will be sent out to you. You can also leave the dividends, in actual fact, to be left on deposit. In other words, if you're saying, I don't really need the money right now, leave it on deposit. I want to just basically accumulate this money. You can leave it at what we call deposit at interest. In other words, you can have different options where the deposits can be invested. So, for example, you may want to invest in segregated funds. You may want to invest in GICs. It all depends really on the insurance company's options that they'll give you. But it will accumulate, and that money is available to you. The next one is what we call paid-up additions. In other words, buying more insurance, the same kind of insurance that your base is. In other words, you want to increase your coverage. So what you buy what's called paid-up insurance, which is probably the most popular one, and the one that you probably will get on the exam, would be paid-up insurance. Please make sure that you read that. The next one is you can actually buy additional term insurance. In other words, use the dividend to buy additional term insurance, what we call special term insurance. That special term insurance is really 1-year renewable term equal to the cash value of the policy. So, for example, if October the 1st is your anniversary date and you've got $50,000 worth of cash value, the dividends will buy $50,000 worth of 1-year renewable term, and that 1-year renewable, if you die any time during that year, until next year basically, you will be insured for an additional $50,000. So if you have a $500,000 policy and you got $50,000 worth of cash and you chose based on special term as the dividend option, the actual death benefit will be $550,000 because that $50,000 cash value is insured for that 1 year. So those are what we call the 5 dividend options.